Well, good morning, West Coast, and good afternoon to everybody else in the U.S. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. Glad you had a little bit of time to spend with us here today. We're going to take about the next 35 or 40 minutes and talk about one of my favorite topics in my 35 plus years in financial services. It's the discovery process, and we're going to have a lot of fun going through this with our speaker, Simon Singer. If you have questions during the presentation, you'll see you've got a tab over on the side where you can jump in, throw some questions in, and we will do our best to answer them during the presentation. If we may have a few left over at the end, so make sure you hang around for that, and we'll share any questions we didn't get to you electronically. I now have the honor of introducing our main speaker today, Simon Singer. For those of you that don't know Simon, he has been successfully in our industry since 1966. He has written multiple, I know, we were just talking about that, how many years that is, Simon. He's written multiple business bestsellers, is a very, very sought after speaker as he, prior to COVID, flew around the country and giving these presentations. Now he's doing it from the comfort of his office in his home right now. In regards to Simon, he is probably the best guy I have, not probably, he is the best guy I've ever seen as far as getting to what matters with the client, how to probe and how to dig, how to ask questions that lead to solutions and answers. So that's kind of where we had that play on words about eliminating your closing line. You do it right, you never really have to ask them to buy. They ask, why wouldn't they? Simon is also the recipient of the National Humanitarian Award program, which is amazing, and that's a handful of folks in the U.S. that can say that. So with that, that's enough praise for Simon. I'm going to turn it over to you, Steph.
Thank you, son. I appreciate it. So as Brad said, we're doing this on behalf of the Center for Tax Strategies and Resources, but I want to let you know this is two things: a prelude to the center's virtual academy that's going to happen later this month, and secondly, it's because we think in these little half-hour, 45-minute vignettes that we can give you an incredible amount of information. I mean, I think we've had 6 of these mini webinars now in the last couple of 3 weeks. We've had 2 tax attorneys. We've had people that are at the very highest echelon of our business and in securities, et cetera, et cetera. So this is my favorite. To be honest with you, if it wasn't for my ability to be able to do discovery, I am just not the smartest guy on this planet. I'm pretty good at parroting what other people do, but what I've discovered was we've all read an interminable number of books on answering objections. I will suggest to you that while I got really good at answering objections, I did a lot better financially and a lot better for my client once I learned how to ask better questions. So when the title of this is Eliminate Your Favorite Closing Line and Double Your Production, because you likely won't need it, as Brad said. So as I said, prelude to the Virtual Academy. I will tell you that this world, whether it be assets under management, insurance, or fee-based planning, it's not the product or the strategy. It just is not. It is discovery, finding out what's in the client's mind, not just what he puts down on a piece of paper, but finding out what's really going on in his head and his heart, and yet all anybody ever talks to this guy about is his pocketbook. Discovery, 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 and you do that by answering questions. So we're going to list a whole bunch of powerful questions. You don't use them all, but they're kind of a lead-in to getting them to tell us what's on their mind. Because if we just lecture them, lo and behold, we finish our lecture and we lost them at the opening and we didn't realize it. So here's a few of them. What's your largest expense? Do you have anybody that pays your taxes for you? Mine are killing me. With a $26 trillion deficit, do you think taxes are going to go up or going to go down or stay the same? And then tell me a little bit about your CPA, your relationship with him, and your opinion of taxes that you're paying. Too much, or is it about right? The whole idea is it is not relevant what their answer is. What's relevant is that you listen carefully to what they said and how they said it. And then I'm going to go into what you do afterwards, because that's a point where a lot of people fail. It's not just the question, it's the question after the question. So let me go through some more questions. What have you done to create tax-free income for retirement? How much of your retirement account is actually yours? It's interesting, when you fill out a financial statement to get a loan at the bank, you know, they ask you about your assets and liabilities, but when they ask you about your qualified plan or your IRA, they basically just ask you how much is in there. They treat it as an asset, but they don't treat the 40 or 50% of taxes that are going to have to be paid in order for you to get to that money. They don't list it on the balance sheet. So do you have the cash to pay the taxes on your IRA or profit sharing plan distributions? Did you know you can have guaranteed income for life? Do you know that estate and capital gains taxes are voluntary under certain circumstances? What have you done to protect yourself from lawsuits, liens, and judgments? Did you know that you can actually insure your IRA or profit sharing plan? Did you know the IRS can actually give you a tax deduction for today for a charitable gift that you actually don't make until after you and your spouse have passed away? Have you ever lost money in the stock market, and can you afford to lose it again? Did you know that there are processes available that will pay you tax-free income if you live too long, die too soon, or need long-term care coverage? Okay, remember, these are just opening questions. And by the way, if you go to our website at the finish of this thing, you can click on important questions. It might say 11 important questions. You can click on there and you can get a copy of most of these questions. But remember, these are just opening questions. So the sale is in the question after the question. So the guy says, well, yeah, I think I'm paying too much in income tax. So he's answered your question. You might say to him, well, what are you doing about that? He'll say, I don't know. Well, what has your accountant suggested? He said, my accountant never suggests anything. All you're trying to do is get deeper and deeper and deeper into the process, not just rely on a data sheet. So being able to ask further clarifying questions is the difference between a small sale and a larger sale, or a sale at all. So here's 25 critical estate planning questions. These are available to our members. The Center for Tax Strategies and Resources, a membership organization. It's not an IMO. It's not a broker dealer. You don't have to change your contracts. It's just if you'd like some mentoring and training from the people at the highest level in our industry, it'll cost you a few bucks a month in order to be able to do that. So here's a sample of the questions. How would you define financial independence? How would you define wealth? How would you define estate planning? How important is ownership of your assets? How important is control of your assets? All of these things are just leading them to say, well, that's really important. If I can't control my asset, I can tell you right now, we can't get an estate planning case done if that wealthy guy doesn't think that he's got absolute dictatorial control of his assets. But nobody's ever explained to him that there's a difference between ownership and control. Are you or your family members at risk for claims of judgment creditors? So that might open a question about, so your daughter is marrying that tennis pro that you don't like. What if she gets divorced? Do you want the family assets to be divided among your future disenfranchised ex-son-in-law, or do you want it to go to your daughter and your grandchildren? It's a way to continue and expand on the conversation. What's the largest charitable gift you've ever made? Who'd you make it to? How did it make you feel? Here's some more. The way your estate is structured today, how much do you think is going to the government, your family, and charity? Let's see, how important is ownership? What's the largest charitable gift? Rank for me how you would value family, honesty, integrity, education, relationships, respect. They're not going to have immediate answers. It's going to cause them to stop and think. And we have some forms that basically say, we want you to prioritize these and tell us what of these areas are most important to you. It has to be modified. If somebody owns a business, he might want to be talking about key person insurance. It just has to be modified specifically. They're just examples. If you had an extra $1 million, but you couldn't spend it and you didn't want to give it to your kids, where would it go? What would you expect them to do with it? Are you aware that capital gains tax and estate tax are voluntary? Do you feel a sense of responsibility to your spouse for contributing to you acquiring and building wealth? Do you believe your current assets and cash flow are more than sufficient to maintain your financial independence, including inflation, health expenses, economic downturns, and other unknowns such as taxes? Remember, we got a $26 trillion deficit. The chances of the tax code, the tax brackets remaining the same is almost non-existent. How would you define financial independence from a cash flow and asset perspective? Do you feel any particular responsibility to conserve your assets for your heirs? And I'd like to get him to say me, I don't really care what my heirs get. I'm worth $50 million. 25 million after estate taxes is plenty. Nobody ever left me anything. I don't want them to become trust babies where they don't have any responsibility themselves. And then I'm going to go into a conversation about how we're not trying to make rich kids richer. We just want you to know that you have a choice of where that extra 25 million goes. It goes to your choice of children and charities or the government's choice of children and charities. Pick them. You got 3 places. It can go to your kids. It can go to your family. It can go to the tax man. Pick 2 out of the 3. So Think about those things. So these are additional questions. Do your children all possess the necessary skills to manage your family worth? You will hear all kind of things, but very rarely are all of the children in possession of the skills necessary to manage the worth. You feel a responsibility to mentor your children to prepare them to manage family wealth, or grandchildren if you're dealing with an older family. If you were physically or mentally incapacitated, would you be comfortable with your children making financial decisions with regard to your health and maintenance? What you're feeling about charity. I'll hear charity begins at home. Well, sometimes I think the reason that more charitable structures aren't created is because people have misunderstandings as to what the word actually means. So if I said to somebody, I want you to create a charitable remainder trust, they hear the word charity. They'll say, charity begins at home. I want to make certain I maintain control of my assets. So I don't want to use words that exactly describe what the strategy is that I'm referencing. I want to use words that describe what the strategy does, not what it called. So I might say something like, did you know that capital gains taxes are voluntary? Wait for the answer. Did you know that estate taxes are voluntary? Did you know if you voluntarily opted out of capital gains and estate tax, the government would actually give you a current income tax deduction today just for opting out of those other two taxes? Were you aware of that? They will always say, no, I'm not. I said, wait, I'm not done yet, because if you set up this series of buckets, not trusts, but buckets correctly, you're going to be able to invest those assets whatever way you want to. You'll never pay taxes on the gains again. You'll be able to draw it as little or as much in the form of income. You will pay taxes on the income that you choose to take. You can actually become a multi-million-dollar philanthropist supporting numerous worthwhile activities, all under the dictatorial control of your family in perpetuity, and do it without disinheriting your children. Were you aware of that? Well, all I described was a net income with makeup charitable remainder unit trust, a family foundation, a life insurance policy, and an irrevocable trust. But think about what people think about. Life insurance, that means I have to die to win. Irrevocable means I can't change my mind. Charity means I'm going to be poor and I'm going to disinherit my children. I don't want them thinking that. I want to control what they think by the use of proper structure and proper words. I hope that makes sense. Let's see.
It does. Let me jump in there a second, Simon. The beauty of that, and I just got off a webinar, third meeting with the client I'm working with, and one of the advantages of going through those critical questions with them, and also the other form you mentioned would be kind of the goals and objectives form, is I've started every one of those meetings with a review using those two documents. So the answers to those questions that we had through discovery, and then their goals and objectives, so that I wanted to make sure we're on the same page. I wasn't doing it because I forgot what they said. I wanted to make sure they remembered what they said and what we had agreed to. And today was the explanation of the insurance solution, and it was ridiculously simple. Yeah, that makes sense. I can see why you did that.
Well, we're going to get to the goals and objectives in a minute. I'm just kind of setting the stage right now. Then we've got 39 family-owned business questions. So are we committed to the future of our family business? Meaning them. Are you committed to the future of the family business? Some will say yes, some will say no. What kind of exit strategy do you have? Do you plan on selling the business? Do you want to sell it internally or externally? There's ways to be able to set up the business in a fashion where it becomes worth more than what they're doing right now. Must we offer every family member a job? Every family-owned business that I've ever dealt with always has the son-in-law of the daughter who owns stock in the company, but she doesn't participate in the company, and her husband doesn't understand why his compensation isn't commensurate with his ownership. Now, the fact that he never shows up and the fact that he never produces anything is completely missing from his thought process. I'm an owner, therefore I should be paid a salary just like everybody else. Should in-laws or other relatives be invited to work in the business? What education or preparation should be required of family members who work in the business? How do you assign titles and work responsibility? How do we evaluate and pay family members who work in these businesses? How do we select the next leader? When do we decide who the next leader is going to be? It just goes on and on and on and on and on. Again, you can get access to these, or the members can. Let me just keep going a little bit, because I want to do some important things. So how to have a successful meeting is dependent on how you set the stage. Think about when you go to a play, when we used to be able to go to plays, or a concert, or a movie. You saw something advertising the event that was attractive to you. Then you saw potentially somebody that did a critique of the movie, for instance. But in this case, when we're trying to have a meeting with regard to financial services, you have to be prepared. I can't even remotely tell you how important it is to practice like you play. Excuse me, I'm going to reverse that. How you're going to play the way you practice. So it's important to be practice perfect. You have to be well introduced. You have to find out why they are there and what they're hoping to accomplish. You have to listen carefully to their phrases and their responses and just how emotional or unemotional they get about particular subjects. Don't be afraid to ask further questions to those initial questions. You're trying to gain clarity. Don't accept their first response because it's almost always their way of trying to end the conversation. Finally, this is so important. Just because they ask a question does not mean that you must provide them an answer. And I can't tell you how much money and time I've spent on books and tapes on answering objections. The bottom line is we don't necessarily know what they mean by the objection they just gave us, and they don't necessarily know what they mean by the objection they just gave us. So you might say something to them like, that's an interesting perspective. That means different things to different people. Tell me what it means to you. And you'll find that a lot of times that objection just kind of disappears into the wind. So sometimes they might give you another type of objection. You ask them the same type of question. Interesting perspective. Tell me why that's important to you. You don't have to give them an answer just because they give you an objection. Okay, here's a generic opening that I've used probably a dozen times now. And it's generic in estate planning. There's a similar one with regard to retirement income planning. But this is literally what I put in front of 3 clients, 7 things you can do in estate planning. This is it. That's all you can do. There are 7 main categories. There's sales, meaning you can sell an asset to typically a trust for the benefit of the heirs. You can lend an asset. You can gift an asset. You hopefully will get discounts on the way the sale is structured or the loan is structured or the gifts are structured. Sales, loans, gifts, discount, charity, non-charitable deductions such as a pension plan, for instance, and life insurance. That's it. Everything else is a combination of these pieces. So for instance, a family limited partnership might be a combination of a gift and a discount. Doesn't have to include life insurance, doesn't have to include a deduction. But just to give you a thought process, what you want to do in the estate planning world is simplify what the prospective client thinks is a very complex world. And it is complex, but it doesn't have to be complex at their level. They only have to know, what do I spend and what do I get? What do I risk? What do I gain? So let's see. All right, here's the goals and objectives matrix that we use continuously all the time, everything. Please rank the following goals in order of importance, where 1 is the most important and 5 is the least important. The reason is it's very normal for people to have goals and objectives that conflict with other goals and objectives. So when we ask them to prioritize them, they've never thought of priorities. They put them all at number 1 until we ask them to start prioritizing. And by the way, I want the wife to fill it out separately from the husband. And when I get 2 of them back, supposedly one from the wife and one from the husband, and they're exactly the same, I know one of them did it. So I will give it back to them and say, I can't help you unless you're willing to help me. It's no different than walking into a doctor's office and failing to tell them where your pain is, failing to tell them why you're feeling bad. They can't do anything without help and information from you. So review of existing estate plan, maintaining our standard of living, maintaining control of our assets, minimizing onerous tax burdens on retirement assets, protecting future generations from themselves. So we want to protect your family from a failed business, from a drug addiction, from a failed marriage, from a failed business venture, and still make them or put them in a position where they can be more than protected so that they have the income that they need in order to continue their lives the way you intended. Converting ordinary income into capital gains, asset protection for us, asset protection for our heirs, equal distribution of assets to our heirs. That's an interesting category. Equal distribution of assets to our heirs. So, our estate is worth $5 million and we want each of our children to get 1/3 of that. So then you say to them, well, are all 3 of them involved in the business? Well, no. So you want your son who's involved in the business to have 2 silent partners and he does all the work and they get half the profit? Well, no, that's not really what I mean. So I'm hopeful you can get the gist of what I'm saying about asking the question after the question, because you can't divide a business in thirds effectively and efficiently without creating huge family arguments. You can't take their house and divide it in thirds. You can't take their car and divide it in thirds. So equitable distribution of assets might mean equitable and equal value, but not necessarily of exactly the same assets. Income tax reduction, estate tax reduction, life insurance analysis, pay taxes on a discounted basis, philanthropy versus taxes without disinheriting the heirs, sell healthcare partners, stock without privacy, mentoring future generations. Let's see, what else? Following your goals and objectives away, maintaining our current lifestyle after taxes, indexed for inflation, maintain control of monies that would otherwise be lost to taxes, provide for an equitable distribution of assets upon your death among your children. For instance, if you got one child who's a drug addict and is in jail, do you want them getting half of your estate so when they get out of jail, they can blow it up their nose? Reduction of their onerous taxation on your IRA or profit sharing plan, reduction of estate taxes, pass maximum value to children, protect assets from the claims of judgment creditors for you, your children, your grandchildren, retain control of your assets, provide more clarity, reduce income tax, more involvement with exploring philanthropic planning options to meet your short and long-term objectives, philanthropy versus taxes. So here's a strategy matrix. So we first went through the goals and objectives. Then we went to the strategy matrix and we start sharing with them all of the possible things with some explanations of how they may or may not be appropriate for them. And we just keep going. Most of these they've never heard of. They have heard of a lot of them. We want to find out what they know, what they don't know. We want them to say to us, yes, I want one of those grants. I'll tell you a story. I'm sitting in a meeting with a very significant business owner who is just, the business that he was involved in was just sold, and his $5 million net worth just went to $150 million. And the tax attorney is explaining how to do a series of rolling grants. And this particular business owner said, well, wait a second, I don't know what a GRAT is. And so the attorney said, well, that's very simple. A GRAT is a grantor retained annuity trust. And he continued on his conversation. Now, the business owner wasn't confident enough to say, wait a second, all you did was substitute words for letters. I still don't know what it does. I had to jump in and I had to say, John, you know what you just did was substitute words for letters. What he wants to know is, what does a grantor retained annuity trust do? Why is it appropriate for him? How much does it cost? What's the upside? What's the downside? And the business owner said, slapped his hand on the table and goes, yes, that's what I want to know. So sometimes we have to act as an advocate for the client and an interpreter for the professional advisor. Private retirement trust, state of California, Nevada self-settled spendthrift trust, California limited liability companies. So once we got past the strategy matrix, we then got to the ones that this particular client wanted to discuss. Complete the estate plan. Are all of your estate documents in proper order? I want to discuss a grantor retained annuity trust, a qualified personal residence trust, a grantor charitable lead trust, a charitable remainder trust, the sale of a limited liability company interest to a grantor trust. Private retirement trust. By the way, that's an interesting California play. It's only available in California. It's not an estate play. It's an asset protection play. Nevada self-settled spendthrift trust, California limited liability and insurance analysis and premium financing and family split dollar. And lastly, a testamentary charitable lead trust. Those were the elements that he wanted to explore. So we took one of the strategies and we showed him a comparison of benefits, not in great detail. So your current plan, your total assets was $35 million. The heirs were going to receive $16.6 million. The estate tax was going to be $19 million. This is when the estate tax bracket was 55% and the exemption was $1 million. And charity got $4.1 million. That was the current plan, shown in graphic form, shown in numeric form. Just by implementing one of the strategies that you previously discussed, the total estate assets were reduced from 35 to 32, but the heirs received 29 as opposed to 16. The estate tax dropped from 19 to 3, and charity got $20 million. No change in his lifestyle. All of a sudden, that became a very exciting, you mean I can become a multi-million-dollar philanthropist without invading my lifestyle and without invading my children? Well, actually, if you do it correctly, you can become wealthier in the process if true wealth can be defined as to what you own and what you can control, because the charity was their own family foundation. So all of a sudden, he gets to control while he's alive, his kids, his grandkids, his great-grandkids, it goes on forever. So that was a short prelude to the Virtual Academy. Our next webinar, and I'm not done yet, so you stick with me, is next Tuesday, August 11th at 9 a.m. Pacific time for our live workshop. You can check your emails. Todd Martis and a tax attorney by the name of Walt Dallas are going to talk to our viewers. It doesn't cost you anything at all. How to use tax reduction planning to obtain our clients. We had a CPA talk about that subject with a national firm, talk about that subject last week. But there's different ways and different styles of being able to approach things. Using tax reduction plans, you're increasing their budget. You're not selling them anything. You're giving them more money to spend or more money to invest or more money to do planning with. It's an amazing topic. It's next Tuesday, August 11th at 9 a.m. All right, this is the secret. If you want to get better, you need coaching and mentoring. I have 4 or 5 people in our industry that coached and mentored me along the way that brought me to a level that I never dreamed I would ever be at. However, we're not the only ones. I mean, all great athletes, politicians, and business people have coaches and mentors. So for instance, here's Tiger Woods and his coach. Here is, I don't even know who this coach is. Here's a baseball manager. Here's, I'm drawing a blank on his name, football teams. Jack Nicklaus with his golf coach. Kenny Stabler with his football coach. It goes on and on and on. Every team has coaches. In baseball, you have a batting coach, an infield coach, an outfield coach, a hitting coach, a pitching coach, a base running coach, a bench coach, a manager, and that's someone that steals signs. Only our industry thinks that we don't need coaching. I'm telling you, it's the biggest mistake in our industry. If you do nothing with else, find yourself a mentor and copy everything they do, the good, the bad, and the ugly. But let me give you an example. So we're talking baseball. The difference between a 250 hitter, meaning 1 hit out of every 4 at bats, and a 300 hitter, which is 3 hits out of every 10 at bats, assuming 27 weeks in a season, 6 games per week, 4 at bats per game is 600 at bats. Well, 180 hits per season creates a 300 average, which results in a $20 million salary and entry into the Hall of Fame. 150 hits, which is a 250 average, results in a $2 million salary and no Hall of Fame. 30 additional hits per season means 1 additional hit per week. 1 ball that hit a pebble and bounced over an infielder's shoulder per week. 1 time per week, the infielder bobbles the ball and the scorer credits as a hit, is a $18 million difference, and their name and lights in perpetuity. Coaching intangibles are the big deal. Just remember, a little help can make a big, big difference. If you're right now making $150,000 per year, if you will let us help, we can get you to $300,000. If you're making $250,000 a year right now, if you'll let us help, we can get you to $500,000. It's not magic. It's having confidence, knowing the right words, having the right relationships, because the resources in the Center for Tax Strategies and Resources are tax attorneys and CPAs and planners that are at the highest level that become available to you that you otherwise wouldn't have access to. I like to be able to walk in sitting on the shoulders of a very prominent tax attorney who, by the way, will be doing, not next Tuesday, but I believe a week from tomorrow, next Friday, he's been talking about eliminating long-term capital gains tax and reducing or eliminating estate taxes completely. And he will be speaking for a couple of hours at our virtual academy. So let's see. If you want to learn more about how the Discovery can eliminate your favorite closing line and double your production, join us at the Center's Virtual Academy. It's August 17th through the 19th. It's 8 a.m. to 3 p.m. Or for more information, you can call 877-258-2837. But let me share with you what this superstar faculty looks like. Bruce Givner is a nationally acclaimed tax attorney with tax strategies that he can implement literally immediately after the academy ends. Joe Strazzeri is also a nationally recognized tax attorney. He's the creator of the Southern California Institute's Laureate Program, which is a training think tank for CPAs and tax attorneys. Curtis Cloak is the preeminent expert in maximizing retirement cash flow. Walt Dallas, we just talked about. Dr. Jeffrey Galpin, fortunately for me, is my personal physician, but he's one of the premier infectious disease docs who's at the forefront of all the research that's being done on COVID, just like he was on the process for being able to minimize the damage being done by the HIV virus. He was a victim of a virus when he was 10 years old. He got polio and he was in an iron lung for a year. That's quite an accomplishment because the majority of people that went into those iron lungs never came out alive. Rick Jay, he's an ESOP expert talking about the opportunities and the traps. Jason Kepi is going to talk about how to use social marketing to fill your seminars, and he's done so with us. We hire him, we pay him. Jason Kirshner is the founder of the Sage Consulting Group. They have a national presence, including doing planning for one of the largest religions in the country. Jerry Minardi will talk about how to be able to use video technology that can be looked at on people's phones or their computers. Todd Martin, tax reduction plan. Mark Pace, he's a national expert in life insurance policy management, not getting rid of an old policy just so you can sell a new one, but how to manage the existing policy. Don Pren's going to talk about the INSMARC software. It's the best software in our industry. Steve Pasek is the CPA that talked about tax reduction plans last week. Dr. Vicki Rackner is the advisory board chair for the Doctors Academy of Economics. John Wheeler is a member of the American College faculty on retirement planning. Mike Zelich is going to talk about all kinds of different qualified plans, mainly defined benefit plans. And Daniel Zepselin is going to take away the mystery of senior settlements, how to create increased efficiency for the clients and create relationships with professional advisors like attorneys or accountants. So Bradley, why don't you take over for me if you would, please? Maybe you won't. I'll do it. If the academy, the virtual academy.
Hold on. I had myself muted because I was buzzing.
Okay.
Investing in yourself, the investment to attend the academy, which is 21 hours over that 3-day period. It's $495 investment. Gets you 3 days and 7 hours per day. It's the same level of things that we've been doing for the last couple of weeks leading up to the workshop. So the very best of the best in the industry, talking about their expertise, things that can increase your practice income, things that can make you better at what you do. So if you broke it all down, it comes out to about $23.57 per hour that you're investing in yourself and to increase your potential. That's pretty amazing seeing. I know one of the tax attorneys is over $1,000 an hour that's going to be spending time with you and has spent a lot of time with us in the past for the group. So join us at that virtual academy. It's the 17th through the 19th. It's 8 a.m. to 3 p.m. Pacific time. The end time's approximate. Sometimes we run a couple minutes over, especially with questions, or if the speaker's on a hot topic and doesn't want to step away from it, we try to let them give us as much information as we possibly can in the time allotted. If you want to go to our website, it's www.yourctsr.com, or you can type in the Center for Tax Strategies and Resources if you prefer, .com. And there's a tab for upcoming events. There's some information about this upcoming virtual academy. By the way, if it sounds like something you want to do, something you feel could help build your practice, anytime in the next 48 hours when this webinar ends, there is a code that you can enter if you want to register. It'll save you 15%. Takes the investment down to $420.75. And that's capital VLA S817. VLA S817 with no spaces. Virtual Live Academy, Simon, 817 for today's.
I think that's my birthday, Brad.
Okay. I always try to figure out what Todd's codes mean. So it's V.
I have no idea.
8717. Okay, Simon, we had a couple of questions that came in, so this probably be a hard to pick that up. So let me pull these up a moment. A few of them we already got to. Bear with me one sec. Okay, you had a question about what software you use, Simon, when you're in your personal practice.
I use two pieces of software. One is I use two of the INSMARC systems. One's their illustration system, and one is Wealthy and Wise. I know how to run those myself. The second software system I use is called Todd. And Todd, basically, I give him an idea and he puts it into a format where I can use it. He's very good at creating Excel spreadsheets. But I will tell you, I hardly ever use the actual document that the INSMARC software produces or that Todd produces. I typically try to talk from a 40,000 foot level, but I want the mental backup that the numbers that I'm spouting to people are basically correct. So it's those two are pretty much what I use.
Okay. Next question came from Steve Radigan. He wants to know, do you practice your presentation with a mirror?
Actually, I don't, Steve. Should I? Steve's an old friend. He lives in
I,
right outside of Houston, Texas. He's got a great practice in helping families of handicapped or disadvantaged children. He does a great job.
awesome. Mike Colthorpe said, excellent webinar again. See you at the Online Academy. Vince, presentations at the Virtual Academy be taped so you can view the presentations. Okay, here's how that works. Our members that are registered for the Virtual Academy will have unlimited access, as long as they're members, to all the material covered in the member portal. If you're not a member, what we're going to do is we're going to give you a temporary passcode. It'll be probably 2 days after the event's over, and you'll have a week to be able to have unlimited access to all of the speakers and all the material. So a week for non-members and unlimited for members. Regarding goals and objectives, why 1 to 5 and not 1 to 3? Does it matter? Yeah, that was Enyi Canoe asking that one.
Well, Enyi, I used to have 1 to 10, so I've been brought into the 21st century and did now do 1 to 5. 1 to 3 very well could work. We just want them to prioritize for us. We want them to give it some thought, so that their thoughts are being transferred to us, so we don't have to try to guess, if that makes any sense.
Yeah. Craig Hebert wants you to know that we all need a Todd software system.
Thank you.
A tool said, agreed, we all need a coach. How do we get a coach? Well, I would think a good place to start might be coming to the live virtual academy the 17th through the 19th, because that's kind of that is a coaching opportunity. You know, you all know online that we're not a IMO or a broker dealer. We're not pushing specific products, and we're not looking to drag overrides. This is about training, education, mentoring, and coaching. So this is probably a pretty good place to start. As far as an individual coach, I think Simon's probably got some good recommendations for that too.
Well, I do, and the members also get an hour with me once a month. And you know, I don't stick to that hour very, very well, because I like doing this. This industry has been more than beneficial to me and my family, and it's kind of a way of giving back. You know, we haven't gotten to it yet, Brad, but you know, the members cost on a monthly basis, what is it, $405 a month? It's not like
$425.
$425. Yeah, that's what membership is. So it's not a big deal. But it's a big deal of what you'll get out of it if you start using it, if you listen, if you're not stubborn. A lot of ifs there.
Yeah, it really is a sense of community. It's a lot of people that are all trying to do the same thing. We do very substantial background checks on members coming in, just to make sure there's no surprises for the other members. And what's kind of cool is a lot of the members actually work with other members to help put cases together and that type of thing too. So it's a lot of people that are forward thinking and like-minded. Okay, got another question. What do you think about capital gain deferral trust? That was from Frank Anderscavage.
Well, what I just described, so you could be calling, oh, Brad, you got to help me with the word.
Conservation easements?
It could be conservation easements, but I would strongly suggest that you stay away from the syndicated ones, because the Internal Revenue Service hates them with a passion, and it's an automatic audit. The ones that seem to work well is when you actually have somebody who owns a piece of property, and they bought it originally for the intention to profit. Things have changed, and now they want to give it to charity. That's okay. They can do that. Installment sales, I think, is what you're making reference to. Installment sales done in the right fashion, in the right way, certainly work. But that's all they are, as a deferral. When I mentioned the way of using charitable remainder trusts, there are other strategies. Grantor charitable lead trust, for instance. Private placement life insurance contracts, where they can take and move not only their investment assets, but they can move a building, they can move a business inside this grantor charitable lead trust. And the economics of those in proper circumstances, with proper guidance from CPAs, with proper guidance from highly qualified tax attorneys, can make those kind of strategies hum. But you go no place unless you do proper discovery. I mean, I had a telephone appointment yesterday with an individual that had filled out a form that said that the first primary thing that they wanted to deal with was the very onerous taxation on their retirement plan. But when I talked about the retirement plan, they had absolutely no interest in figuring out a way to eliminate those taxes. The answer was, well, why wouldn't I want to keep the money in the retirement plan and let it continue to grow on a tax efficient basis? So we need to do a better job of discovery. We've all made mistakes like that. It's just something, the reason we want people to focus on what the objectives are is because we can't go anyplace. It's like our menu. It would be like you telling your wife, you know, I want to go on a trip, but I'm not going to tell you where we're going to go. I'm not going to tell you how we're going to get there. I'm not going to tell you what hotel or quality of hotel we're going to go at. I'm not going to tell you what we're going to do when we're there, but I want to have a trip. The more detail you've got, the more we like to be able to act as a travel consultant as opposed to a travel agent, if that makes any sense.
No. Thank you, Simon. Ian Grove wants to know if there's going to be virtual happy hours during the academy. Thank you. Thank you for that.
That's up to you and Robert, Ian. Knowing Robert, wait a second, I'm just going to answer yes for him.
There you go. That's about it for now. So I think we probably want to wrap this up with just a reminder again of what we've got coming up here with the Virtual Academy. Again, the 17th through 19th, 8 a.m. to 3 p.m. Pacific. Go to our website, www.yourctsr.com, and click on the upcoming event tab. Again, it's $495, but if you move right 48 hours from right now, it's $245. We will leave that open for a discount of 15%, bring it down to $420.75. If you have any questions, please feel free to reach out to us at 877-258-2837 or email the center team at yourctsr.com. And we would look forward to seeing you at the Academy. And keep in mind, we got a couple of really, really good vignette meetings here next week. So make sure you check your email on that. If you don't see an invitation to attend one of the two video workshops we're doing next week, jump on into our website and you can pull up upcoming events from there too. So look forward to seeing you again in the near future. Success and health to you. And Simon, thank you for going through all that material.
Thanks for your help, Brad, and everybody have a good day. Remember, intangibles make the difference. Bye-bye.